It usually starts with one flashy screenshot. Someone on Instagram or Twitter posts, made $2,000 in 15 minutes from my phone. The chart is green, the numbers are huge, the emojis are fire. Welcome, folks, to another discussion on designing, nurturing, and running your own financial flywheel. There are popular posts that say features and options are the fastest way to financial freedom, and anyone can quickly do it. Your brain gets hooked. You imagine yourself quitting your job, trading from the beach, sipping coconut water while money flows in. And here lies the trap. What you don't see are the thousands of people losing money quietly in the background. The sleepless nights staring at a screen, and the fact that those big wins often come after big losses. In short, the hype sells the dream but hides the risk. So, are futures and options a gamble? So, what is it? In this discussion, we will uncover and put before us what to make out of the F&O market, the reality behind futures and options hype. We will try and demystify. Essentially, there are 2 points to discuss. One is the asymmetric risk. The odds are stacked against you. Next is leverage. In the context of asymmetric risk, in F&O, you can risk a lot to make a little, or risk everything trying to make a lot. One wrong move and your losses can snowball faster than you can refresh your screen. Unlike buying a stock where your max loss is what you paid, F&O can take more than your initial capital because of leverage. And yes, next, what is leverage? Leverage is that double edged sword, which means you can control a big position with a small amount of money. Sounds great, right? Example, with say 1 lakh rupees, you might control 10 lakh rupees worth of a stock exposure. What is the catch? A 1% move against you wipes out your capital. It's like driving a Ferrari at 200 kilometers per hour. It is thrilling until you are on a straight road, deadly when there's a sudden turn. What is the bottom line for young investors then? F&O isn't inherently evil, but it is a pro level game played with real stakes. So, if we jump in without understanding asymmetric risk and leverage, it is like walking into a casino thinking the slot machines are there for our benefit. So, let us look at this particular analogy. Okay, for us, we know that fire can cook our food or even burn our house down. In the same context, with futures and options, without the right knowledge, it's gambling. With the right skills, it's a tool. The choice is ours. Financial flywheel, we aim to build the foundations with the right knowledge. So let us step back and look at the word called asymmetricity. Imagine you bet 1000 rupees on an F&O trade. If you're wrong, you could lose the entire 1000 rupees. Sometimes even more if you're leveraged. If you're right, you might make 500 to 800 rupees. You see the imbalance 1000 versus 500 to 800? Your downside could be everything, but your upside is limited. That's asymmetric risk for you. The scale tips heavily against you unless and until you deeply understand what you're doing. Think back to high school math class. Remember the probability distribution curve? In the world of futures and options, this curve becomes your best friend. Before we even dive into what an actual F&O trade looks like, here's the big picture for us. F&O simply creates leverage positions on something else that is popularly called as the underlying. That something could be a company stock, a commodity, gold, oil, or even an entire market index. Now, here's the catch: your profit or loss at any moment isn't random. It depends on a handful of measurable parameters like the underlying price. There's something called as a volatility. In the context of contracts, there are time to expiry and much more than that. Your job as a trader is not to gamble, but to design strategies using these tools, looking at the probability distribution curve, and adapt as the underlying moves so that over time your net result stays on the positive side of the curve. So, this is when you, as a trader, stop playing the market as a gambler and start engineering outcomes. A deep understanding of looking at models in the context of a probability distribution curve scenario will help greatly as a trader. Again, this analogy of a probability distribution curve is something that not many traders would probably talk about, but I find it a very convenient mathematical model to look at how a person trades. So, futures and options give you powerful tools, but just like a chainsaw, power without a skill can be dangerous. I would like to bring to our attention that it's surprisingly easy to turn the F&O into pure gambling. For example, one could buy a far out of the money call or far out of the money put option for a very small cost. If that low probability bet suddenly moves in the money, the returns can be huge, leveraged, far more than you have invested. Sounds interesting and exciting, right? But here's the problem: the odds are stacked against you, and the thrill of maybe this will hit can become addictive. That's how many traders confuse the entire F&O ecosystem with Las Vegas and end up donating their money to the market. We will break down these concepts in upcoming sessions, but for now, remember this: without strategy, F&O is just a flashy casino with better lighting. We saw asymmetric risk. There is leverage. When F&O works for you, it multiplies your gain. When it doesn't, it magnifies your losses, sometimes beyond what you started with. But first, what's leverage? Let's try and understand it with tools that we are semi familiar with. Let's say you buy a house worth, say, $500,000, say $500,000. You put in 10% as your own money, which is $50,000, and take the remaining 90%, which is $450,000, as a loan from the bank. Happy case scenario: a huge tech company announces they are building a campus just 5 minutes away. Demand for housing explodes in your neighborhood, and your house value doubles to $1 million. So that is $100,000 in a different metric system. You sell the house. The sale price was $1 million. You pay back the loan of $450,000. You keep the remaining $550,000. So overall, you put in $50,000 and walk away with more than half a million, which is $550,000. That's approximately 11x your return, right? Okay. Now, let us look at the scenario where the leverage didn't actually work in your favor. Things become terrible. A leather processing plant opens nearby your neighborhood, bringing noise, smell, and pollution. Housing demand tanks, and the value of your house halves, sadly to say, $250,000. You are forced to sell. Now your sale price is $250,000, but you still owe a loan to your bank for $450,000. After selling the house, also there's a shortfall of $2 lakh. You must pay this from your pocket in addition to the initial capital that you have already put of $50,000. So the lesson, leverage makes outcomes bigger in both directions. In good times, massive profit with small upfront money, and in bad times, huge losses, even more than what you have invested. So let us now understand in the context of leverage and asymmetricity how a gambling mindset really works. Does a gambling mindset looks at asymmetricity and leverage in a mathematical probability distribution function fashion? No. In the mind of a gambler, gambling is pure chance. You win or you lose. And when the odds turn against you, you have got no tools to fight back. A gambler chases the thrill, not the result. No strategy, no rules, just pure indulgence. Okay, but let us look at the mindset with a twist. Assume that the moment this gambler now brings in a plan, clear entry and exit rules, and the discipline to follow them. Even while this gambler inside a casino gambles with slot machines and games that get operated within a casino, because of these principles and strategy, he ceases to be a gambler and becomes a trader. So, end of the day, what matters is not the game that one plays, whether it be a game of slots or blackjack or anything that gets played in a casino. What really happens is if the mindset is kept in tune with that of a trader, then the very act of a gambler being in a casino can become that of a trader being in a casino. With this important distinction, let us understand how, as a fresher, one really gets drawn in into futures and options. People get drawn in with big promises, big gains, social media hype, screenshots of profits, and what they don't see are the asymmetric risk, leverage, and why quick money stories don't show the losses. F&O is not pure gambling if you know the rules. Gambling is an outcome based on toolless speculation, whereas F&O are tools you can either speculate or hedge with strategies. The sheer distinction between the two of gambling mindset and a trading mindset is intent, knowledge, and risk control. The danger zone for beginners is that leverage magnifies both wins and losses. However, most retail traders lose because they treat it like a slot machine, not as a probability distribution function based math. So, what is the smarter path? Learn to trade with no actual exposure using YouTube channels, blogs for free to start building your knowledge. Learn to use F&O to protect investments, not as a get rich ticket. To create cash flow, with an underlying that you are comfortable with using paper trades and not money. Once you are satisfied with the consistent outcomes of the paper trades, slowly expose money that you are comfortable losing and see how the model actually responds to live market scenarios. In conclusion, in the wrong hands, F&O is a loaded weapon. In the right hands, it is a shield, a spear that can help contribute to our financial flywheel. The choice and the outcome is ours. Thank you for your time. Good luck with all that you're doing. Until we meet next, bye.